Uncle Sam, he's always going to come knocking. He always wants his cut. That's it.
Hello and welcome back to the Future Value Podcast. I'm your host, John Pellosie, alongside my partners, Joe Freemont and Justin Ahner. This is part 2 in our series on Investing 101. In our last episode, we looked at the basics of stocks, bonds, mutual funds, ETFs, what we call allocation, right? The different investment vehicles you can purchase. Today, what we're going to talk about is what we call asset location, or what we also call the money buckets. And this really focuses a lot around the tax characteristics and treatment of different types of investment accounts. So we're going to go through those buckets and then spend some time talking about each of the separate account types that make up those buckets. And to kick it off here, I'm going to turn over to Justin to talk about our first bucket.
Yeah. So the first bucket is your traditional pre-tax bucket. I feel like that's the one that most folks are already familiar with. That's your typical, I'm going to put the dollars in today, pre-tax. So you get to deduct that from your income, which is always nice because you don't have to pay the taxes today, right? So everybody loves that benefit. And then it grows tax deferred. So you're not paying any taxes along the way. But one of the potential downsides is you do owe the taxes later. So Uncle Sam, he's always going to get his cut. He is going to get you on the backside of that.
I would say that the pre-tax bucket or the tax-deferred bucket is, first off, it's an accountant's best friend, right? When you meet with your accountant, every accountant, what does accountants want to happen, right? They want you to pay the lowest amount in taxes, right? So they really encourage their clients, and we love our friends, the accountants, if there's any accountants listening. But when you put that, you are incentivized to save for retirement by getting that income tax deduction today. But I think we're going to talk about some other buckets here that might be a little bit more advantaged for you to have a well-diversified bucket moving forward. But it's also the most common bucket that we see as planners, right? So many people have traditional 401ks, which we'll talk about more of the types of accounts here in just a second. But that was the most standard form of account for the longest time until more options were developed over the time.
Yeah. So Justin, basically, when someone's starting in their investment journey, would you say this is one of the buckets that they kind of first encounter?
Yeah, typically. I know for a lot of younger folks, they might be getting their first jobs, looking at their 401k or a similar plan like that. And typically, this is going to be the first place that they're going to see something like that.
Okay. And outside the 401k, are there any other, what are some of the other account types that might fall into this first pre-tax bucket?
Yeah, so your traditional IRA, any contributions you're putting into that is also deducted from your income today.
Okay, excellent. And I know we'll get into the specifics and contribution limits and all of that on each of those accounts a little bit later. All right. So bucket number 1, Joe, we talked about pre-tax. You get that deduction today and you pay your taxes later on. What is bucket number 2?
This is definitely the most exciting bucket, John. Very excited. I was given the opportunity to talk about this one because this is the tax-free bucket, right? When we hear tax-free, your ears and eyes must perk up immediately, right? If it's tax-free, it's definitely for me, as I would say, right? So these are Roth allocation dollars, right? So these are money that you put in that's after taxes, right? So you're not taking a deduction to put the money into either a Roth IRA or a Roth 401k, right? And that money is growing tax-free over the time that it's in that investment account, right? And when you go to pull it out, it's completely tax-free. So both the amount that you put in and all the gains that you've accumulated over the years are also tax-free. We love this as financial planners.
And Joe, what might be when we look at that, what might be the advantage for a young person in going with something like that as part of their starting investment journey?
Excellent question, John. So when we're a young professional, right, we're typically in the lowest earning years of our lives, right? So hopefully you aspire to make more and grow in your career over your working years, right? But we know that taxes are a gradual system, right? The more money that you make, the more taxes that you're paying in our system. So if you think that hey, I'm going to make more money in the future, I should put my monies in Roth because it's going to be tax-free when I'm making a higher dollar amount later.
Okay, that makes sense. So what are some of the vehicles, just at a high level, where someone can get that that tax-free bucket?
Yeah, so I already mentioned our Roth IRA and our Roth 401k. Those are the main vehicles, I would say. But for some folks, when they make a little bit on the higher side, those options don't become available. The Roth 401k is always available. Let me just clarify there. But the Roth IRA, to make those contributions, depending on your income or whether you're single or married filing jointly, you may phase out of that benefit.
Okay.
So a strategy that some clients use is it's called the backdoor Roth IRA, right?
Okay.
So you're putting money in a non-deductible IRA, and then you're later converting that over to Roth IRA dollars.
Okay. So in essence, that conversion, they'll pay the tax then and move it into the Roth. So it basically does the same thing. It's just kind of an extra step.
You got it. It's just a couple extra steps to make sure that Uncle Sam sees it in compliance with it all, right? Yeah.
Got it. Very good. Very good. Justin, I'll come back to you now to talk about our third and final bucket. So we talk about, the tax deductible today or pre-tax bucket. Then we talked about tax-free. So I guess what's left?
Yeah, so it's your non-qualified or taxable accounts. And I feel like a lot of younger folks may actually be more familiar with this. I know that's actually where I got my start in investing. You get on there, you invest a couple bucks, and you play around in the market a little bit. But I feel like they've really taken off a lot in the last couple of years, especially since COVID. But really what it is it's you're investing your after-tax dollars similar to the Roth, but there's no tax benefit to it.
Okay.
So as you're seeing dividends, interest, any income, or realizing gains in the account from hopefully your stocks growing in value, you're going to pay the taxes as you see that income.
Okay. So given that you pay taxes along the way, what's the advantage? Why would someone use that versus one of the other buckets?
Yeah, there's a lot of flexibility. The name of the game is flexibility in this kind of account. There's no penalty. There's no fees to withdraw early, as there are with some of these other qualified accounts. So it's a great vehicle for someone with some of those midterm goals. Maybe there's a home purchase on the horizon, or you can start putting dollars away today with the goal to use them maybe 5 to 10 years from now.
Okay. Very good.
So Justin, you mentioned penalties, and I actually don't think that we talked about that quite yet. Could you go a little bit more in depth about what kind of penalties you mean in relation to the qualified accounts?
Yeah. So for the pre-tax, if you make a withdrawal before you're 59 and a half, you're charged a 10% penalty on those dollars on top of the taxes that you would owe. So obviously that's not ideal. You don't want to pay more than you owe, than you have to. But that's the pre-tax. With the Roth accounts, you're always able to take what you put in. So any dollars that you put in, you can always take back out. But anything above and beyond your cost basis, you'll also be charged that same 10% penalty.
Right now. And really, when we look at the retirement accounts, it's exactly as the name implies, right? The goal is long-term, in the future, past retirement age. Kind of the magic year in a lot of cases is 59 and a half, right? That's the year where, you can take from your traditional IRA without any penalty. You can take from your Roth IRA the contributions and the earnings as well. And a lot of times 59 and a half is the year for 401ks where you can do things like in-service rollovers. We'll get into some more of those details a little later on as well. Very good. So now that we have kind of this outline of our buckets, let's do a little bit deeper dive, if we could, gentlemen, on the specific plans. And I think I'll start with you, Joe, on the 401k plan. Again, that's one that I think many or most of our listeners will be very familiar with, something that they have access to. So kind of what are the details as far as contributing to the 401k and all of that?
Yeah, I always like to take this into the perspective of somebody just coming out of school, right? So you've graduated from school. Hopefully you don't have too much student debt, but you can go to our other episodes on debt management for that, right? But you're sitting down and you've got your signing letter and you're saying, okay, here's my salary, here's this, here are all the benefits that I have, but I'm looking at that shiny 401k account, right? This is my employer sponsor plan. Now, a 401k is very similar to a 403b or other types of 457 plans, depending on what institution that you are working at, right? If you're working at a government institution, it's probably a 457. If you're working for a nonprofit, you're likely having a 403b or a 401a, right? So these are employer-sponsored plans that are incentivizing you to contribute towards your retirement, right? And that's because they offer a match, right? So your employer is saying, hey, I want to incentivize you to save for retirement. So if you elect to put away a certain amount of your salary every year for your retirement, we're going to match you to a certain aspect, right? So an example that I'm thinking of here is that I'm making $50,000 right out the gate from college, right? And I decide that I want to put 6% away into my employer-sponsored plan. Well, my employer is saying, hey, Joe, we will match you half your contributions up to that 6%. So a top contribution of 3% only if I put in 6%. If I put less than that, they're going to do half, right?
Right. Are there any other plan structures? The match percentage, I think, is probably one that's very common, but are there any other structures for how employers make contributions to 401ks?
That's an excellent question, John, right? So there's different types of plans, and there's a whole lot of rules about 401ks. I'm learning about this a lot in my CFP studies here, but one type of plan that your employer can do is it's called a safe harbor contribution, right? So no matter what you put in, they're going to say, hey, to make sure that we're not discriminating towards our highly compensated employees versus our non-highly compensated employees, we're going to just put in 3% across the board, right? So whether you put in the 3% or not, that company is going to put in that amount for you. And actually, I think it's really important. I just want to cut before we talked about the other part, is that employer contributions are always considered pre-tax bucket contributions, right? So there has been recent legislation that said, hey, maybe you can make a Roth one. But for the most part, if your employer is making a contribution, assume that it's a pre-tax dollar. The other type of contribution that your employer can make for you is profit sharing contributions, right? So that's a amount that they're willing to contribute based on the profitability of the business.
Got it. And so we talked about how the employer's contributions essentially always are into that pre-tax bucket. But what about the employees? So when you're having money deducted from your paycheck, how does your money get treated?
There's really three main types of contributions, right? So we have kind of similar to our buckets, actually, really. There's the pre-tax, right? The Roth contributions, and there's the after-tax contributions, right? So traditional, think of that, what Justin was just talking about earlier, right? I get my deduction today, it grows tax deferred, and then it's fully taxable after my age 59 and a half, or with a 10% penalty if I access it before that, right? Roth tax-free. But the after-tax, that's an interesting one, right? So you're making additional contributions, and these are growing tax deferred, but I believe that they're all taxed at ordinary income as well, John, if you correct me.
No, that's correct. And frankly, that's one I don't see utilized too much. It seems that for the most part, for people, they're accomplishing their objectives using either that traditional pre-tax or Roth buckets inside the 401k. The Roth option is a relatively new option inside of 401k plans. Most plans today I see offer it, as I understand it, but I do think it is on a plan-by-plan basis. So it's possible you might not have that option in your company's specific plan, but from at least what I've seen nowadays, most people do have the ability to contribute on a Roth basis, which I think is a good thing. It's good to have that flexibility.
Yeah. One last thing on the employer-sponsored plan. I want to go back to that match. If your employer is offering a match, that's free money. It's free money. You would be shocked. We look at so many young professionals' statements, and we see, hey, your employer is offering a 3% match, but you're not contributing to get the full amount. That's 100% return on your money, right? Why would you miss out on that? So we would highly encourage, take a look at your benefits. Make sure you're taking full advantage of that.
Yep. Justin, as far as the 401k, how much can someone put into that? I think we talked about some of these buckets have limits to them. So what does the 401k look like?
Yeah, it would be really great if there weren't limits, because we could just drive dollars as much as we possibly could. But of course, all good things have some limits. And John, to answer your question, for the 401k specifically, now these are 2025 numbers. This year, for an individual employee, you can contribute up to $23,500 if you're under 50. If you're between the ages of 50 and 59, you can contribute what's called a catch-up, which is an additional $7,500 for a total of $31,000. And this is a relatively new idea here, too. It's called the super catch-up. So if you're really nearing retirement and you really need to drive those dollars into the account, you can now contribute an additional $3,750 for a total of $34,750 if you're between the ages of 60 and 63.
Okay.
Quite an aspirational amount if you do say young professional. I don't know if I'm looking at those contributions. So that's a little intimidating for a young professional's perspective.
It can be a lot. We have some folks who work their way up to that over time, but if you're just starting out, don't get intimidated if you can't put in anywhere close to that amount, right? As Joe was saying, it's good if we can get that match. We definitely want to try to do that and start with where we can. Right. Justin, continuing on with that pre-tax bucket, outside of the 401k, now looking at like the traditional IRA, which is another common account, could you tell us a little bit more about the rules again around that?
Mm-hmm. Yeah, so very similar. It's an account that you have outside of your employer, so anybody can open one. Very similar. There are contribution limits and some rules regarding tax deductibility. If you make over a certain number, you can't deduct it from your income. Again, they're great tools, and Uncle Sam acknowledges that they're great tools, but you can't use them indefinitely. So for the 2025 contribution limit to a traditional, this also applies to a Roth IRA, is $7,000 if you're under the age of 50, and if you're 50 or older, you can contribute an additional catch-up of $1,000.
Okay, very good. Now, with the with traditional IRAs, as I understand it, there's some rules about withdrawals, right? We talked about a minimum age to take withdrawals, but there's also some rules about starting to take withdrawals too, right?
Yep.
Could you talk about that?
Yeah, so required minimum distributions, RMDs, those pesky RMDs. So obviously, we're getting a great benefit by taking the tax deduction today, and it's growing tax deferred. But Uncle Sam, he's always going to come knocking. He always wants his cut. That's it. So once you get to a certain age, depending on when your date of birth is, you'll be required to take a specific distribution from the account so that Uncle Sam can get his cut.
Okay, interesting. Very good. All right, Joe, will you share some more facts with us on the tax-free side and the Roth IRA?
Did you say Roth? I just perked it up, John. Well, Roth IRAs, again, anybody can open up a Roth IRA, but not everybody can contribute, right? And I know from a married filing jointly perspective, the phase out on the income limits are around a little over $210,000. It's when it starts to phase out. So I can't think of the single numbers off the top of my head here, but really, if you make under that amount and you're married filing jointly, you're able to contribute $7,000. And if you're above age 50, you can make an additional $1,000 for a catch-up contribution, right? But again, these are those tax-free dollars, right? You're not getting a deduction for putting in that money, but it's growing tax-free. And this is a great asset for those of us who are thinking way down the line, and maybe for our retirees, we're thinking, hey, I want to take that vacation, but I don't want to worry about the tax ramifications, right? Or, hey, I'm looking to give money to my descendants, right? But I don't want to worry about giving them a ticking tax bomb.
Right.
And so, cool things about the Roth IRA that I didn't mention. I know we have mentioned this so far, but again, those cost basis or the amount that you put in is able to be pulled out beforehand if you need to get access to that money. We obviously, wouldn't want to do that. It wouldn't want to be the first place, right? I had an emergency expense. Well, I got to put money for my Roth IRA. That's why we have emergency funds. And that's why we have emergency funds. We don't want to be pulling from this if we get out.
Right. And one thing I think is good to talk about, to tie it back to our last episode about, allocation, stocks and bonds and that, is to talk about the investment options inside of all these vehicles. So the 401k plan that someone has at their job, typically there's going to be a kind of a preset list of investments to choose from, right? So depending on your company, depending on your plan, they might be offering, 20, 30, 40, often mutual fund options to choose from. Oftentimes, many of those are what we call target date funds. So they're funds designed to sort of match up to what your projected retirement date is. And say you're in your 20s now and your retirement date is maybe 40 years plus out. That fund is going to be a little bit more aggressively invested today, right? It's probably going to be close to 100% in stocks. And then as you go, the level of volatility in that fund will get drawn down. So they'll move more into bonds, more into safer investments as you go. So that's one very common investment that we see. But we also often see funds that are in specific asset classes or industries, right? You might see a large cap growth fund or a small cap value fund or an international stock fund. But the point is, in 401ks, typically you're seeing more of a defined list of investments and you choose from one of those offerings. When you get into IRAs and Roth IRAs, often you get a lot more flexibility. So now that's an account, again, individual retirement account, and you can take that to many different places. You can hold many different types of investments. You can hold mutual funds and ETFs, but you can also hold individual stocks and bonds. And even in very specialized types of IRAs, you can get into some even more kind of exotic assets like real estate and gold and all that kind of thing. So there is flexibility, I would say, from an investment perspective that the IRAs can bring.
That's a great point, John. So there's actually one more type of account that we haven't talked about. And I actually want to turn it to you, John, because there's a lot more considerations when it comes to that non-qualified tax bucket, right?
Right. Yeah. So number 3, again, that third tax bucket, this is where we're looking at things like a brokerage account, right? Sometimes we call it non-qualified, non-retirement, but it's really a brokerage account. You're opening it up at a financial institution. There are countless companies that you can do this at. But, the idea here is pretty wide open investment options, right? If it's a publicly traded asset, you can buy it in your brokerage account very easily. And as we said before, no contribution limit, no limit on withdrawals. No, we don't have to worry about timing or anything like that or particular ages. And the big thing here when we're investing in something like that is, like we talked about last time, is making sure that your investment lines up with your objective for the account. With retirement accounts, we kind of have a sense of what that time frame is going to be. Again, if you're in your 20s, you got a long time to go, right? So we have a good idea of how we can invest for that because we know it's a long time from now. In the brokerage account, we have to be a little bit more thoughtful of, okay, is this money we want in 10 years? Is it money we want in 5 years? Shorter term or longer term? That's obviously going to dictate how we want to invest those dollars. But the big piece, as you said, Joe, this is a flexibility, right? And it's great for building wealth on top of the other things that you're already doing inside of some of the other plans.
Awesome. So I keep going back to I'm a young professional. I'm straight out of school. You guys just overloaded me with a ton of information. 3 buckets. What kind of buckets? Roth, traditional, and then non-qualified. We just talked about some of the accounts.
Right.
If I'm looking to just get started, what are some easy steps that maybe I want to start looking at and thinking about for myself?
Yeah, absolutely. So especially, again, if we're focused on that young professional person, I would say first step, which is what you mentioned, is start with your company 401k, if your company has one, and contribute enough to get the match. Like you said, it's free money. It's 100% return on your investment in the sense that they're giving you that match percentage. So we definitely want to make sure we do that. I would encourage most young professionals to really consider using the Roth bucket inside their 401k as well. Obviously, there can be certain special circumstances where that may not be right, but for by and large, I think for most people, that can be a really good place to start. The next thing I'd have them do is once they've hit that match, look at opening a Roth IRA and contributing to that and maybe maxing that out. Again, that just gives you some flexibility in the investment choices and some access to the principal should you need it in a situation like that. So I would say the Roth IRA would be number 2 for as long as you can contribute to that. Number 3, I look at opening up that brokerage account. So making sure you've got maybe all three of those buckets broken out, and start to put some away in that. I think that's a very important tool, again, for young people to build money toward those goals that are going to happen between now and retirement, right? Future home, perhaps future education for their own kids, all of those kind of life things that happen, in our working years. I think it's good to save up money in that bucket and have the flexibility to take it out.
Now, John, I already hear the financial gurus typing in the comments section, right? John, what about the rest of the 401k? But I think it goes back to what you're talking about with the more nearer term goals, right?
Right.
If all of our investments are going towards retirement and you're retirement rich early on in your career, well, how are you going to get access to all that without pulling out like Roth basis and whatnot? So I think that's excellent advice for somebody who's getting started.
Well, and we've seen that too in our careers, right? We come across people sometimes later on down the road as they're maybe 10, 15 years out from retirement, and all of their money is in the pre-tax, or mostly all of their investments are in their pre-tax assets in that one bucket. And that poses some unique challenges, right? If they wanted retirement to happen a little bit earlier, there's going to be a little bit more difficulty perhaps in accessing that money. And it just doesn't give good balance, right? I think at the end of the day, having balance is important, and using all of the tools in a coordinated way is what we want to do.
So John, you said, get my employer match, right? Idealistically try to max out my Roth IRA or at least build up to that, right? And then if I had extra dollars for other goals that are more longer term, mid to long term, think about that taxable account.
Yeah.
Where should that professional go after all that if they still have more money that they want to?
Yes, yeah, and if they do, which is awesome, and we see it with some of our clients, I would say in that case, you can definitely go back to the 401k account and continue to add more than just what you were getting matched on. I think that's totally fine, as long as we're also saving in those other places and making sure we have the money we need when we need it. Right? That's what it's all about at the end of the day. But by all means, as a step 4, go back to the 401k and continue to max that out.
Thanks, John. I feel empowered. I know all my tax buckets. I know kind of where I should get started. That's excellent.
Yeah, well, thank you. I mean, that's really the goal. Is it's a lot to understand, but the goal is finding balance. And I think for most people, what I would encourage our listeners to do is to say, if you're having trouble figuring it out, by all means, reach out to your financial advisor and have conversation with them about where you're at, what your cash flow available for investing is, and help that, work with them to figure out an investing plan that makes sense for you in all of those buckets. Well, with that, guys, I want to thank you for joining me. I want to thank you all for listening. If you found this podcast helpful, please subscribe, leave a comment or a review. Feel free to share this with somebody who you think would benefit from it too. And on behalf of my co-hosts here, I'll say again, thanks, and we'll see you next time on the Future Value Podcast.